Welcome to this trading tutorial on trading MACD histogram. Today we're going to go over the details real quickly of how it's calculated and then how to trade it when it's helpful and when it is not. So the MACD histogram, trading this thing with Forex, futures, stocks, whatever, it's all the same because it's based on price action. So first of all, let's talk about what it means. And when I say what it means, that's because it is a mathematical formula. And so let's talk about what it mathematically means. This line right here, what I have colored in green, that is what's called the MACD line. MACD, that stands for moving average, convergence, divergence. Alrighty, but that's the MACD line. Now this red line is actually a moving average of the MACD line. So the typical calculations for the MACD line is the 12-day EMA minus the 26-day EMA, exponential moving averages. And then the signal line is a 9-period EMA of the MACD. Okay, then we'll talk about the histogram here in just a moment. Now, so if you look at this, the MACD line, let's look at that first. Since that is, again, the calculation of the 12-period minus the 26-period EMAs, what I've done here is I've put these EMAs up here. All right, you can see them. So the 12 is the light blue one, the 26 is the dark blue one. So what you'll notice is that when there's no difference between them, then the MACD line will hit 0. So right here, it hits 0. Why? Because, and there's your, right, that's your 0 line right there, because there's no difference between the two moving averages. All right, now here it never hits 0. Why? Because these two lines, these two moving averages, never hit each other until about right there, and then sure enough, it goes back down to 0 again. So when the two moving averages converge and they touch, then the green line, the MACD line, which is the difference between those two moving averages, will go to 0. It's as simple as that. All right. So now when the MACD line, getting a lot of arrows here. So when the MACD line, the green line, is moving up, basically what that means is that these two lines are moving further away from each other. So because the 12-period EMA is faster than the 26-period EMA, it will accelerate a little faster, and that'll cause this to go up. All right, and basically what that's measuring is acceleration. So it's often referred to as a momentum indicator, but in my never to be humble opinion, that's actually a misnomer. It's more acceleration because momentum implies mass, and there's no mass involved in the equation whatsoever. It's simply the difference of the speeds between the two moving averages. So, okay, there you get that. Now when they come back together, all right, so they're converging here, then you'll see the MACD line goes down. All right, again, now the what's often called the signal line, the 9-period moving average of it, my red line. Really not too much to say about that. That's all there is to it. It's a 9-period moving average of this. Some people use that as kind of a smoothing of the MACD line. Actually, there's a lot more we could say about it, but not for today's purposes. So today's purposes, we want to get to this MACD histogram. So what the heck does that mean? That's the black thing down here. All right, so what this measures is very simply the difference between these two lines. All right, so the green line, MACD line, measures the difference between the two moving averages. The red line is the moving 9-period EMA of the green line. But the histogram now, this was added by Thomas Asprey, and he added it to provide somewhat of a faster indicator, because since the MACD is based on moving averages, moving average convergence divergence, it's lagging. And all moving averages have a lagging component to them. So in an attempt to try to speed things up, he created this. So basically, again, it's just measuring the difference between these two lines now. So you see when they cross, the histogram goes to 0. When they cross, histogram goes to 0. When they cross, the histogram goes to 0. So you got the same principle here now, except it's not based on the moving averages. It's based on the MACD and the signal line. When one is moving up faster than the other, then the histogram will move up. And now sometimes you'll see that this can be moving up and this can be moving up. But if this one's not moving up as fast, then the histogram will actually go down. Why? Because the distance between these two lines is getting more narrow. And then when they start getting further apart again, of course, now we're going to the downside, then this will go down. But notice how here it's still below it, but now the distance between it starts to shorten up or getting smaller, and so this goes back up. Okay, so that's the basic mathematics of it. That's all well and good, but how do we trade this puppy dog? Okay, so what most people do is they look for divergences, and that can be okay. It's something that has to be done in context, so let's talk about that context. So here you see you've got this making a lower high, price making a lower high. So, should we go short? That'd actually be a convergence. And the answer is no, that wouldn't work out so good. But what about here? You got a convergence there as well. Also not so good. Here we've got a convergence going up, and here we have this going up, but here we have this going down. Now, see, this is where you could see where Thomas Asprey was looking to create something that was faster, because here we still have the MACD line going down, but we have the histogram making a higher low, lower low, higher low. And that's exactly what he wanted, is to give a faster signal. Now, the key is, again, in the context of the market, it's with the trend, right? It's with the trend. It's not against the trend. And that is exactly what the role of this histogram was to do, was to give earlier, faster signals in situations like this. Let me pull up another example for you. All right, so here we have a similar situation. Now we're in a downtrend, and we have the MACD line going up, making higher highs this time, but this time we have a lower high on the histogram. So again, giving an earlier signal. Again, it is not really a divergence, it is a convergence, because both price and the histogram are making lower highs at the same time. So I want to be careful to point this out. A lot of people are always looking for these divergences. They can be good signals in certain contexts, in certain situations. But don't ignore these convergences as well. They are quite often better. They are showing you that the energy of the market is continuing in the way that it's been going. In other words, trade in the direction of the trend. Don't keep fighting the trend. The problem with divergences is often that they're fighting against the dominant energy of the market, and they can be very short-term signals, and that's a big mistake I see a lot of traders making. Now, let's bring up one last example before we finish up. Okay, so let's finish with this chart now. I switched markets. I went over to the futures market, the NQ, and I'm using tick charts. And it's just to show that this will work in different markets, different time frames, and so forth. So what we have here now is we do have a divergence. So we have a lower low on price, and we have a higher low on the MACD histogram. So now why is this a better signal with a divergence instead of a convergence? The reason is very simply because we are now late in a trend. So that is the key. The trend is your friend until the end, as I'm sure you've heard. And so the longer a trend continues, the less likely it is to continue. So when we're early in a new trend, I'm not real keen on divergences. I'd rather trade in the direction of the trend with a convergence. But toward the end of a trend, after it's very extended, then we know the probabilities are no longer on the side of the trend. The trend has become your enemy, and therefore, if you want to look for trend reversal trades, that's when you might want to start looking for divergences. So, hope this video was helpful for you. I've got a bunch of videos here on YouTube, and I also have a free course that I make available to my YouTube subscribers, so feel free to get that by clicking on the green box in the top right corner of the video here. Also, by the way, in that course, it's not just general information. I give you one of my favorite trade strategies called the rubber band trade. So that includes entries, exits, all the rules, everything. My gift to you for free. Take it, start making some money, hopefully, And if you have any questions, you can email me and ask me questions about the trade. I'll be happy to answer you. Also, hey, if you love this video, give it a thumbs up. If you have any comments or questions, put them down below. I love your encouragement. It really keeps my engines going to continue to create more free tutorials for you.